Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking private equity and its role in energy transition. Trillions of dollars of capital are needed to achieve the energy transition. Yet there are real challenges and complexities in how organizations go about deploying that capital, and thus defining private equity's role in the sector. We're going to discuss the opportunities and those complexities, and in part how to overcome them. Our guest is John Skrinar, partner at Cresta Funds, a mid-market, midstream and downstream focused private equity group that invests in the energy transition. Also, on February 22nd in London, we have our latest HC Insider Podcast live event, this time hosted by Benchmark Mineral Intelligence. We'll be discussing the trading future of critical metals. Tickets are free but limited, so please RSVP. I'll put the links in the show notes if you wish to attend. As always, you can really support the show by leaving us a 5-star review or a thumbs up on YouTube or wherever you listen to the podcast. It really does support the show, enable us to build our audience, and continue to get great guests. And as always, I hope you enjoy the episode. John, welcome to the show.
Thanks, Paul. Glad to be here.
So we're talking today about private equity and private equity's role within the energy transition. Let's all just get on the same page for a moment. Can you just sort of give us an outline of what we mean by private equity and its typical goals and targets and timeframes and so forth in how they go about investments?
We think of private equity as 4 different things that have 4 different labels, right? So the early stage, riskier, higher return bucket is typically venture capital. And then you've got growth equity, buyout, and infrastructure. And there's all kinds of other, little subsectors within there. But those are the 4 main things, I guess. And traditionally, it's VC, growth equity, and buyout. And infra has sort of emerged in the last 20 years as its own asset class. And you've got infra-focused funds all over the place now. And you've seen recent transactions where BlackRock bought GIP. They wanted to augment their infrastructure efforts, and that was how they decided to do that. And so that's again, it's an evolving world, but those are the 4 main places where private equity capital is deployed.
Perfect. And just typically in general, how do these organizations go about investing? What are their sort of the mechanisms to realize value and roughly the timeframes?
Again, it depends on the objectives. It's equity, it's debt, it's alternative credit. Now we've got structures that are called unitranche, where it's almost like a multiple layers of debt compressed into one security. So some of it is really long term, right? And you've got groups that are creating continuation funds that are really open ended and meant to hold things for a long time. I think of the type of things that Cresta is involved in is shorter term. VC stuff it depends on how they exit, right? It could be a couple years, it could be a longer time. Buyout capital, which is probably the largest pool of capital in private equity, is 7 to 10 year type capital. Ours tends to be under 5-year holds in our investments. So it's a range, right? It's a large range depending on the goals and objectives of the capital.
And typically, I'm right in saying that the majority, especially in the buyout realm, these aren't passive investors, right? They're typically there to change management teams, to work with the organization to really drive a better outcome than were they to continue on their own, so to speak.
Yeah, I mean, I think there's lots of different styles. There's thousands of private equity firms now. There's the big household names that people recognize like Carlyle and KKR and Blackstone, and then there's lots of small mid-market funds that are more similar to Cresta, like somewhere between $500 million and $2 billion under management. And so everyone has their own style, but I think the historical perspective, and a lot of those large generalist private equity firms are doing that. They're looking to combine businesses, create efficiencies, financial optimization around the capital structure, right sizing the size of the teams and the employee bases at certain companies. And so, that's a strategy. That's not what we're involved in, and I don't think at this stage of the energy transition that there's a lot of room. There's a lot of capital that's been formed around energy transition in those types of strategies. Our perspective is there's not a lot for that capital to do yet. There just aren't large platforms to go and combine and optimize yet. We've got to spend a lot more time building before we get there.
Fantastic. Okay, and we're going to move on to the energy transition shortly. But just to set the scene, how has the broader macro environment been for private equity since COVID, right? There's been a lot of challenges
Yeah.
and a lot of seismic changes, particularly when it comes to interest rates, a story that we've covered quite extensively on this platform. Can you just give us sort of set the scene for us?
Yeah, well, I mean, look, I think there's been obviously the world has shifted dramatically over the last 4 years. And there has been a lot of great opportunities to deploy capital and make great returns. There's also been a lot of things that have been headwinds, obviously, as you mentioned, interest rates. But certainly, especially around the energy transition, I think what happened in COVID and throughout the last few years has created an urgency around the energy transition that I think is creating a lot of opportunities. That being said, I think there's also there's in addition to interest rates, there's a lot of other headwinds. I think the costs of the energy transition are probably starting to be realized in certain instances. I think a few years ago, everybody was very excited about hydrogen as a fuel and as a molecule that's going to power everything. I just the physics and the practical reality of it aren't such, at least in today's world. Maybe at some point in the future. And so I just think there's a lot that has to be done. And so there's opportunities and there's challenges, as there always are. And I think that maybe what COVID had created was extreme tales of wonderful opportunities and really significant headwinds. Obviously, the passage of the IRA in the US and that's impact on the energy transition is potentially quite profound. I think there's obviously a lot that's to be determined with that legislation and how it's interpreted and applied, but potential significant tailwinds too. So I think it's pretty balanced, Paul. I think there's lots of challenges and lots of opportunities, and you've got to figure out how to navigate it and try and succeed.
Yeah, which is the story we're about to tell about the opportunities and those complexities and some of the ways to approach those. Just saying, okay, so let's just talk the opportunity of the energy transition. There's sort of two elements to this, right? There's one which is the scale of change that is demanded and the opportunities for those that are going to be in financing that, but just the sheer scale, right? The trillions of dollars globally that are going to be needed to decarbonize the economy and at the same time make aspects of it more sustainable. There's also the sort of the flip side of that, which is a little bit narrative and expectations, at least in the public, can sometimes be way in advance of the timeframes and the scale of lift required, right? So can you just, I guess, talking about the energy transition, can you just, in your context, is this sort of dominating every single potential opportunity out there? And really, do you think private equity itself as a broader sector is aligned to step up to that challenge?
The scale is tremendous, right? And I think the corollary that we often draw as we talk to investors is shale and the midstream opportunity from early aughts to 2015, 16, and how that evolved from really opportunistic midstream companies trying to connect a seller of something and a buyer of something, and where they could fit in between. And as that evolved, it became really dominated by strategics who came in and said, well, we can manage this whole thing. We don't need these middlemen. And that was a couple hundred billion, many hundreds of billions of dollars opportunity that was pursued pretty rapidly by private equity firms and alternative capital. And I think that the scale that we're talking here is many, many times that, right? Like trillions upon trillions of dollars of potential capital formation around opportunities in the energy transition. And so, that's that sort of Permian shale opportunity set that's fresh in people's minds, and sort of how that evolved is the closest corollary. And then you can also look at sort of the evolution of green power, right? Early 90s is when you started to see wind become more prevalent, and that was a 30-year runway to where we are now, where it's one of the cheapest sources of power, albeit intermittent, but one of the cheapest sources of power on the planet. And that's a long opportunity set. So we look at those two markets over the last 15 and 30 years, and try to see how they are a barometer for what is likely to happen in this energy transition segment, certainly on the non-power side of things. I think that's pretty well attended. There's a lot of capital there. There's a lot of experience building and developing those assets by really large global companies. There's publicly traded pure plays around them. And on our, where we're looking in the decarbonization of non-power, there's not been as much capital formed. And so that's where we're focused. And I think that's where there's the biggest opportunity.
Comparing to the sort of the tech opportunity suite that's been present for the last 40 years and the extraordinary amount of wealth that's created for venture capital, private equity, and so forth, this transition is sort of a hardware, not software transition, right? It's very much playing into, I guess, the infrastructure spectrum of private equity, and in some ways kind of back to basics in terms of investing capital and so forth.
Yeah, absolutely. Look, and I think there's a lot of capital raised in the VC world for clean tech. I think our perspective on that is that it's needed, and there's a lot of great things that are happening and are probably going to continue to happen coming out of that early incubator type of capital. But the challenge that we see is, as you build salesforce.com or LinkedIn or Instagram, the next user you add is effectively free. It doesn't, you've built out the infrastructure to power your systems, and so you can just keep growing and have, whether you have 5 billion or 8 billion users on your platform, the costs to run it aren't significantly different. When you invent a new way to create a fuel that doesn't have the same scale, it's still going to cost you, X millions or X billions or whatever the quantum that we're speaking of to install that, right? You've got to go and build the real asset that's going to do what you want it to do. And so I think there's this challenge between the VC mindset and the infrastructure mindset. And certainly infrastructure type capital is looking for really stable yields. They don't want any risk. They want creditworthy counterparties. They want fully wrapped construction projects. And that's the type of projects that capital is looking for. Low risk, low yield, sort of the bond mentality. And VC is very different. And I think that what we need is somewhere in the middle of those two things around the energy transition. And I think folks are still figuring out exactly what that's going to look like, and how those risks are going to be interpreted, and who's going to bear them, right?
Yeah, and let's lean into that, because I think this is a bit of a unique opportunity to get some insight into someone who's been looking at all of these many different projects, who's been in the energy sector for yourself for nearly 20 years. There's so much complexity here, and you can classify it around technology, policy, regulation, land use. There's geographic variances. Let's start with the technology piece. One of the challenges of the energy transition, as I see it, is there's some, we kind of know the end state, right, which is in the end really going to be about the electron. The pathways to get there are much less certain. And you just see that on, for example, hydrogen's journey, right? We're already seeing today in Europe county councils, regional districts that invested in hydrogen buses are now scrapping them, and so there's a lot of technology volatility there. How, can you give me some sense of, is that a fair statement? And secondly, how do you go about mitigating that aspect?
Sure. Yeah. Well, I think it's a very accurate statement, just to say that out at first. I mean, hydrogen, let's just pick on hydrogen for a second because you raise it as the example. I think as we think through hydrogen, it's got a lot of great attributes. Energy density is not one of them. It's a very small molecule, so it's leaky, and it doesn't transport well. And so you've got to do other things to make it move around. And I think when you combust hydrogen, it's thought of as this holy grail molecule because there's no emissions. But the reality of making hydrogen at scale and deploying it into all these different uses that I think have been advertised globally for the last 3 or 4 years as where you could be using hydrogen. I just, from our perspective, it's not, it goes against the laws of physics. As with what we have today, with the infrastructure we have today, with the power generation we have today, and sort of what we see on the horizon for the next decade or two.
I'm sort of just interested in the process, right? The thought process, because yes, again, right. And I think about this podcast journey with hydrogen, right? And our first one was sort of, the Swiss Army knife approach, this is amazing, to sort of a much more nuanced look at it. And there aren't many experts in many of the facets of the energy transition, right? This is not, lots of these technologies are nascent. There's only very few individuals who understand their, not only obviously the technological piece itself, but also the application. I mean, how do you can imagine there's a number of private equity firms that have probably fallen into the trap around investing in, let's say, a particular given hydrogen as a fuel project that's now looking pretty bleak. I mean, sort of, how do what are the sort of the frameworks, the process to be able to actually sort of manage that technological volatility?
It's a great question, Paul. And I think the reality is it's not really a technological challenge, right? The technology to make green hydrogen is there. We know how to do it. It's been replicated a number of times. It's just really expensive. And getting the right supply and source of power is still somewhat of a challenge. And then again, using it, right? If you're going to put it into a bus, it's just not the right molecule for that today. I think where we see hydrogen opportunities that make sense is where you have great renewable power production, some region, right? Let's use the Southwest US. You've got great solar attributes. You can generate, tremendous renewable power supply while intermittent. It's still, significant. Then you've got the ability to take that green power, electrolyze it, and turn it into green hydrogen. If you can use that on site, it's a tremendous value proposition. But if you've got to then take that hydrogen and put it in a pipeline or blend it with methane and move it through a pipeline or compress it and put it into a tank and drive it somewhere else, it just decays the return on that energy investment, right? I guess that's the best way for me to put it. And so when we're looking at hydrogen, we're looking at very specific opportunities to where either that green hydrogen is a lower cost production of hydrogen than the incumbent gray hydrogen, or it's a lower or a similar cost, but the areas where you can monetize your end product are compensating you with some sort of cost of carbon. And so that to us is the only way that you can really invest in hydrogen today. I mean, we've got this great new, potential law coming out, the 45V as part of the IRA, and Treasury's been working like crazy to put this out, and they gave some guidance at the end of the year, and there's going to be a big fight over what's going to be considered green hydrogen in the U.S. and what's not going to be considered green hydrogen in the U.S. Once that's settled, I think you'll be able to make more of those types of investments comfortably. But today, we still don't even know what the rules really are, right? And I think that's a big part of it.
Yeah.
And that, we're sort of leaking into policy now, but I think that's, it's a natural transition from the the first part of this conversation.
Yeah. It sounds like what's key is obviously actually moving beyond the headlines, and obviously, this is why, it's a well-paid community in private equity, right? But actually following the molecule, following the electron through to its end use, and a deep dive into the economics. I'm sort of just fascinated by this idea of kind of, you've got every week, every day, there's a new sort of panacea technology comes, it's going to, whatever it might be, right? And it just seems to me that, it's probably pretty hard to sort of push back on kind of your investors and say, well, I know you're hearing a lot of headlines about hydrogen, but we're not so sure, and this is kind of why, right? I mean, I think there's a bit of stakeholder management there and a bit of kind of narrative management all about the energy transition, just simply by the fact that yes, it's relatively new, and there's lots of technologies available out there, all with attached to lots of promising statements.
The challenge that we've got, right, is what we believe is needed in this energy transition doesn't fall in the elegant boxes of buyout or infrastructure or growth equity. It's this chameleon in between a bunch of things. And so oftentimes when we're talking to potential investors, they're not really sure which group we should be engaging with. Is it the infra team? Is it the natural resources team? Is it the real assets team? Is it the private equity, broad generalist group? And I think a lot of the LPs out there are still trying to figure out how to invest in this, and some dip their toe in VC early because that's how they had done things in the past, and so it was an easy way to approach it. Others have been more aggressive, but I think the reality is they're still pretty cautious. At least the investors that we deal with, they're still pretty cautious, and so I don't think we're getting a lot of pressure to chase hydrogen as an example, or green ammonia, or anything else that's sort of in vogue in the mainstream press. I think the reality is they want stable returns at the return targets, and they're really more focused on us delivering on our promises around how we invest capital, how we protect their capital, what we do when things go wrong. So as much as I understand your question or your statement, we've actually been pretty lucky that we don't have folks pushing us to do those types of things. They're more focused on us doing what we have been doing and really continuing to do that. And how long is that runway? Is this something you think lasts for 10 years, 20 years? I think in our mind, it's evolving. And so the themes that we were investing on in 2020 and 2021 are not the themes that we're investing on today. In 2021, we embarked on a process to retrofit an oil refinery to renewable diesel and sustainable aviation fuel. That's not where we're looking today. We think that there's been a lot of a build out around that space. We're excited about our project, but to go and start another new project in that area just doesn't seem. It seems like it's you're a little bit standing still. We're to borrow the phrase from Wayne Gretzky, we want to skate to where the puck is going, and so that's how we're trying to invest.
The HC Insider podcast is brought to you by HC Group, a retained search, intelligence and advisory firm focused solely on the global energy and commodity sector. With 6 locations across Asia, Europe and the Americas, and over 50 consultants. To find out more, go to our website, hcgroup.global. There, you can also sign up for our HC Insider content for more interviews and white papers on relevant trends and talent impacts in the commodities world.
Okay, well, let's bring in policy and regulation, because that also introduces a significant amount of volatility, right? You could be on the right side of the IRA or potentially not, depending on whatever rules and how they land, right? There's also just looking at the moment in EU battery regulation, right? Profound changes over the next decade as how they're treated. I mean, this is a consequence, a great consequence of political focus on this as a challenge globally. But you've also got the inefficiencies, the sort of the time lag to policy, all of these pieces that mean it can have a profound effect on the economics of your project. And we've just described that, okay, well, to get around the technology piece, ultimately it's about real world economics and due diligence and not sort of wishful thinking. I guess this adds an element that can distort all of those equations.
Yeah, 100%, and it's something that we focus on all the time. It's something that our LPs and prospective LPs are focused on, and it's a question that we get constantly. How do you think about policy? Our style and our strategy is to invest around what we view as more durable policy that's been litigated, policy that's been fought by the trade groups of the opposition and supported by the trade groups of the proponents. You can look at the RFS in the U.S. I mean, it's a hotly debated policy, but it's a policy that's been in place for almost 20 years, and it's been litigated. And so I think when we look at investments that some portion of their revenue is going to depend on the RFS, we're okay with that. We understand that that's going to be part of that revenue stack, and we think it's durable and it's going to be there. We don't think it's going anywhere. Similarly, the California. I mean, there's volatility in the price of the environmental attributes that are created by that policy, and you can't escape that necessarily. But the policy itself is durable. Similar to I started bringing up the California LCFS. Same thing. That policy is just not going to go anywhere. On the contrary, I spoke earlier about the 45V, and I just don't think that anybody knows what that's going to look like. And once it is finalized, how's it going to be litigated? How's it going to be fought in the courts? How's it going to be fought by politicians? Are they going to, as a new administration and Congress, going to change these things? Again, we don't think the RFS is at risk of those types of changes, but new legislation may be. And so it's hard to say, I'm going to go out and underwrite a project where I've got, a 45V credit and a 45Q revenue line and all these other potential policy tailwinds when you just don't know. I mean, we saw that happen in ethanol, right? A lot of folks put a lot of money in ethanol in the early days that probably didn't necessarily get great returns. I'm sure plenty of people made money, but there's a lot of gun-shy private equity folks. I can tell you firsthand, there's a lot of gun-shy private equity folks and investors who got burned by the early days of ethanol and overbuild into sort of an uncertain policy that didn't necessarily do a great job of supporting them. And again, the world's just shifted a lot in the last 20 years, and so there's certain things about policy that we think are easy to invest on the back of, and others that are challenging. And it's an evolving beast, right? I mean, you've got new policies in Canada that should have the impact that the LCFS has had in California, or more so than that. And there's constantly evolving policies in Europe, and so it's a big part of the evaluation of any given investment. I don't think that's going to change anytime soon, Paul.
No, it's a challenge though, isn't it? Because much of those valuations come down to whatever credit tax breaks are applied to any given product and its environmental attributes, and obviously, ethanol and, et cetera, RINs and all this piece. But also it's a competitive landscape as well, as you mentioned earlier on. That there aren't that many projects, right, at the moment in general. This is a relatively nascent sector globally, and you've got to be competitive in your bids, and therefore, if you're discounting those policy underpinned prices, it makes it you're not going to be as competitive as, dare I say it, the private equity group who got it wrong, right?
As somebody who's taking more risk, yeah, absolutely, yeah. No, it's not for the faint of heart, for sure. I think balancing, especially when you think about the evolution and the capital that's trying to flow into the space, conventional energy is a really old business, and there's new ways to do it, and new ways to move it, and new ways to extract it. But when you get oil out of the ground, you have a good sense of what it's worth, and you see a futures market that's priced out 4 or 5 years, maybe even further in some cases. You can understand, what you're dealing with, and there's a way to sort of run models that give you some semblance of comfort on what you might have. Not to say that there isn't unintended consequences and surprises that pop up and make people accidentally a lot of money or lose them a lot of money, but it doesn't have the same layers of risk as this energy transition, right? And it's because it's a new thing. It's got new policy, new regulations, new molecules, new technologies. And so I think as investors that have moved or are looking to move either all of their capital or some of their capital out of conventional energy into the energy transition, they're looking at it going, God, this is so much riskier than all the stuff that I was investing in for the last 20 years or 30 years or 50 years. How do I get comfortable with it? Right. And that's a huge challenge.
We should just note on people as well, because there is a challenge there, right? And the projects we've done, obviously, worked with you guys in the past, and more broadly in the sector, there's a very talent is a scarce resource. It's even scarcer when it comes to some of these new technologies and all facets of them. And as you say, you've really got a choice between, okay, I need to somehow bring in people who are familiar with these new technologies, with these new policies, but I also kind of need that weathered experience of someone who's seen a longer time series in any given energy play as well, right? It's in and of itself, even finding the C-suite for a portfolio company, in this rapidly changing environment is a challenge, and a little bit of trying to find a combined team that capture all of those aspects.
It's a microcosm of everything I just walked through on the risk side, right? It's the same thing where there's not a lot of talent that has done the things that are needed today. So you're trying to find skill sets that are applicable, that can transfer from whether it's conventional energy or agriculture or renewable power, right? And sort of just the evolution of that and the policies and regulations around that. And how does that look now in some of these other, emerging markets? It's all pretty complicated stuff. It's not for the faint of heart.
Yeah, and it's also there's an opportunity for geographic arbitrage, right? Because there is talent that sits in Europe that brings a lot to the table when it comes to certain aspects of the energy transition. Unfortunately, this is at the same time where it's almost impossible to get visas globally. We've got this sort of fracturing and deglobalization of the global talent pool, which in and of itself is causing a challenge, right? Whereas 10 years ago, if you were to look at the renewable power community leading the charge in the US, many of them were from Spain, Latin America, other regions where they'd had 5 years jump on the US. And I just find it fascinating that that's now, for the most part, a pipeline that's been shut down or is much more difficult to do. So I think that's a good sampling of the complexities, and you're sort of you're doing private equity on hard mode when it comes to a lot of this stuff. What does it mean as well? There's a lot of money flowing into this, right? And the nature of that has changed since COVID. There's a lot sort of an emphasis on ESG. I think we're in sort of ESG 2.0 as a guest, an earlier guest has highlighted, and there's a zooming in on the energy transition. But there's not that many projects compared to the capital that's interested in it. So I'd like to get a statement on the sort of the competitive landscape out there and what that looks like. And then finally sort of move towards kind of what you think would be accelerators to achieving the energy transition with private investment, and what may be things that can happen when it comes to policy and so forth that would help that. But let's start on the competitive landscape. I mean, what does that look like today?
I think as I sort of mentioned earlier, there's a lot of capital that's been formed by the big incumbent firms, TPG and Brookfield and BlackRock and groups like that, where I think these are like hundreds of billions of dollars across those large platforms that are pointed at energy transition or decarbonization. But as I also mentioned, and as you've acknowledged, that there's just not enough opportunities for that capital today. And I think the competition is really in securing those opportunities that are seeking capital. But the other side of it is, a lot of those groups that I mentioned a moment ago, they don't have the capacity to drill down to the small opportunity set that we're looking at, right? So we may look at deals that are in the $20 to $80 million range on a typical basis. That doesn't mean things above and below that aren't considered, but that's generally the scope or the quantum of capital that we're looking to deploy in any specific opportunity. And Brookfield, they just have a hard time drilling down that small. They need to be deploying much more. I mean, if they have 15 or 20 billion in their last fund that they raised focused on this stuff, that's hundreds of portfolio companies. It's really untenable. And so where the competition lies for us, and I think where the competition is focused today, is building out those platforms that are ultimately probably best suited inside the larger buyout shops as they mature to steady state operations and cash flows and somewhat predictable growth. And so, where we see competition is really from either our mid-market private equity firms that understand construction and development, or it's strategics that are saying, I've got to be in this space, so I'm going to deploy some capital here and, either back a team or build out my team and provide them with the capital they need for growth. And that is probably the largest pool of competition for us, is the strategics rather than other financial sponsors.
Yeah. Can you just define strategics just for me?
Yeah. I mean, it's anything from Shell and BP, Chevron, to utilities, right? Folks that are using the products that they're creating is how I think of strategics, right? Or distributing and moving the products that they're creating rather than an institutional investor that's just there for a return on.
Who have been incredibly active, right? And again, it's a case where in that, one could argue, not in all cases and maybe not in many, sometimes the economics also don't apply there either, right? There's just a stakeholder demand that there's some kind of action going on, and that improves multiples and so forth, and so they can be very competitive on these projects. And as you say as well, right, they also benefit from typically having the talent inside that can better operationalize some of these things earlier on, right? I mean, that's a pretty powerful competitor, I imagine.
Yeah, again, and that's why I make this statement that I do, that's probably our largest competitor in these projects, is the strategics who have the capital, the know-how, the people, the need, and in many cases now they've made commitments and they're trying to meet those commitments. So while we may have a return threshold that we're underwriting to as we evaluate projects, they may not. They have a lower cost of capital most likely, so they certainly can beat us on the cost of capital, but they also may have other reasons to do an investment that we can't compete with. But all that being said, I think the other side of it is it's not too much different with the strategics than it is with some of the larger private equity firms. Yeah. Sometimes the micro granular nature of an individual project is just challenging for them. And so they don't get much bang for a $50 million investment. And so they're looking to find ways to deploy far more capital than that. Yeah. Again, that's where we try to play.
And then I know this is actually a really tough question, but it's kind of like, what is the grease for the financial world to really? We started at the top talking about trillions of dollars needed, right? And you've highlighted some of the complexities. I mean, it's kind of, we're in a year when I think the largest number of people are going to vote ever in the history of humanity, right? You've got elections across Asia, across Europe, here in the United States. And there is this sort of somewhat mismatch between policy timeframes and investing timeframes, both a lag in enacting and so forth. You've also got a mismatch between, for example, federal policy or EU policy, and then how it actually hits the road in terms of local councils and local policy and so forth. I mean, and again, I know this is an unfair question, but what do you think are sort of some changes that could happen that would really accelerate the ability of a capital to flow into the energy transition?
Yeah, well, listen, I mean, the thing that always comes up in our discussions internally and with external stakeholders is policy, right? And I think getting either it's coordination on policy or the carbon border adjustment type where look, I think when we look at policy, we don't necessarily need favorable policy. What we want is stable policy. And that's much easier to underwrite than policy that's moving around. And so, part of that comes with time, as my example earlier in the RFS, where, there were moments in the RFS where you didn't know what it was going to look like the next year at all. I mean, it was really sort of two sides of a coin, and however it landed. And I think we're just sort of past that. Now it's a market mechanism. And, we've been seeing that in the RFS recently. There's been a lot of build out of renewable diesel production capacity, and there's a big generation of RINs. And so RIN prices are down, a third of where they were a year ago. They're down, they are 1/3 of where they were a year ago. We're not concerned with that because we understand the policy is stable. And so I think that's the piece that, to try to answer your question, Paul, that I think we need the most. It's going to take the most time, right? Because you don't get policy stability overnight. You don't get it by having a new exciting policy.
Yeah.
You get it by having that policy beaten and tested. And so, it is a bit of a patient process that you've got to sit through and understand that. And that's not easy, but starting to see durable global policies or durable national policies across the globe is probably a better way to put that, will bring capital into it. And I think that's probably the best way for me to put it.
Yeah, which is looks pretty uncertain given sort of the volatility globally in politics, and also now increasingly in judicial rulings as well. Well, it's been a really interesting discussion and, tough gig. But I guess I just want a couple of minutes on Cresta, just so people know what you are about and where they can find you.
Sure. Yeah, I mean, they can find us on the web. Obviously, our website is crestafunds.com. We are, as I said earlier, we're a middle market private equity firm really focused on development opportunities around the energy transition and focused exclusively on molecules. So we don't, build wind turbines and solar panels and things like that. We're focusing on decarbonizing the industrial sector, and inside that broad definition, the ag and ag waste and municipal waste and transportation and heavy industry, and then where we can try to bring proven technologies to emitters and help them achieve their carbon reduction goals.
Fantastic. Well, John, it's been a pleasure to have you on, and hopefully we can have you again in a couple of years and continue the discussion. It's it's a lot of food for thought, I think, in our discussion.
Thanks for having me, Paul. Great discussion as always with you, and best of luck.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.